What if I told you one of the world's biggest economies just pulled off a nearly 20% annual stock market surge, not from foreign money, but almost entirely on the back of its own citizens? We're talking about India, and by mid-2025, domestic investors were pouring a record $4.91 billion into equity mutual funds in a single month. That's a massive shift from what we typically see in emerging markets. Usually, it's global hedge funds and institutional investors driving the bus. But in India, everyday people, the mom and pop investors, are fueling what analysts are calling an equity revolution. How did this happen, and what can we learn from a market surge driven from the inside out? Did you know that India's stock market is currently experiencing what Morgan Stanley is calling its longest bull run ever? They're projecting equities to rise 20% annually over the next 5 years, fueled by a booming economy. In fact, India's economy is expected to leapfrog Germany and Japan to become the world's third largest by 2027. That's a massive shift in global power, and it's happening right now. But what's really fascinating is who's driving this surge. While global investors have been a bit hesitant due to international uncertainties, domestic Indian investors are pouring money into their own market. Back in July 2025 alone, flows into Indian equity mutual funds hit a staggering 427.02 billion Indian rupees, or about $4.91 billion US dollars, a brand new record. This isn't just a flash in the pan, this is a consistent, powerful trend of local capital fueling and national economic transformation. This story isn't just about big numbers in faraway markets, it's about understanding how domestic investment can insulate a market from global headwinds, and what that means for someone considering diversified international exposure. We're going to dive into the specific drivers behind this equity revolution, looking at the macroeconomic stability that's setting the stage, and what lessons we can draw from India's journey as it navigates both growth and geopolitical uncertainty. We'll explore the details of how this growth is unfolding and the implications for the future. Now, this isn't just a flash in the pan, it's a testament to profound structural shifts. The Indian stock market has shown incredible resilience and growth, especially in the last decade, even with global conflicts, supply chain disruptions, and the unprecedented COVID-19 pandemic throwing curveballs. Think about it. As of June 13, 2025, the sensex had surged a staggering 202% over the past decade, climbing from 27,316 points on June 19, 2015, all the way to 82,756 points. That's a massive, consistent move, far outpacing many developed markets during the same period. Priyasha Mohanty, an equity product specialist at PineBridge Investments, highlighted on February 20, 2024, that this surge isn't merely speculative, it signals significant long-term opportunities rooted in fundamental economic expansion. And it gets even more compelling. Morgan Stanley Research, in a comprehensive report titled India, a decade of outperformance from June 10, 2024, is actually predicting India's stock market is poised for its longest bull run ever. They're projecting equities to rise a remarkable 20% annually over the next 5 years, driven by robust macroeconomic stability, a burgeoning middle class, and a surge in domestic investment, with retail participation through SIPs, systematic investment plans, reaching record highs. This kind of consistent growth trajectory is expected to elevate India's economy to become the world's third largest by 2027, surpassing even economic powerhouses like Japan and Germany, reaching a projected GDP of $5.5 trillion. The lesson here is that sustained growth often requires strong internal drivers, insulated from external volatilities. This equity revolution, as the CFA Institute called it in their October 2025 analysis, is primarily fueled by those very domestic investors, who now represent a formidable force in the market. This isn't just about big institutional money though. This current surge is what the CFA Institute, in their comprehensive Global Market Outlook report published on October 2, 2025, precisely termed an equity revolution, driven almost entirely by a burgeoning new wave of domestic investors. Consider the landscape. Foreign institutional investor, FII, flows, particularly from large players like Vanguard and BlackRock, were actually quite subdued through the first 3 quarters of 2025, registering a net outflow of $3.5 billion in Q2 alone, largely attributable to persistent global inflation fears and geopolitical tensions in Eastern Europe. This starkly emphasizes the profound internal strength the Indian market commands right now. We saw this play out emphatically when flows into Indian equity mutual funds, spearheaded by schemes from ICICI Prudential and SBI Mutual Fund, hit an unprecedented record high of 427.02 billion Indian rupees, or approximately $4.91 billion, in July 2025 alone. That colossal figure represents a monumental vote of confidence from ordinary local citizens, many of whom are first-time investors from Tier 2 and Tier 3 cities. Interestingly, the COVID-19 pandemic, which began its global sweep 5 years ago from January 10, 2025, acted as a powerful, albeit unexpected, catalyst. Nitin Kamath, CEO of Zerodha, in a recent Z-Connect post, estimated that the pandemic drastically accelerated market changes that would probably have taken decades to organically play out. We witnessed this period transform into one of relentless growth, with demat account openings skyrocketing, peaking around September 2020 as millions of new investors, many in their 20s and 30s, entered the market en masse, seeking alternative income streams and wealth creation opportunities. The undeniable lesson here is that sometimes, unforeseen global events can drastically reshape a market's underlying dynamics and accelerate trends that were already, perhaps subtly, in motion. Now, even with this robust domestic engine powering forward, no market operates in a complete vacuum, and India has certainly been skillfully navigating its share of global headwinds, including supply chain disruptions and volatile commodity prices. Now, despite these strong domestic drivers and the palpable excitement around India's economic future, the market isn't immune to global turbulence. The Indian stock market, like any other major global index, remains susceptible to geopolitical uncertainties, particularly conflicts like the escalating Iran-Israel tensions. An ICICI Securities Team report, dated March 21, 2026, explicitly identified the Iran-Israel conflict and broader West Asia headlines as the single biggest driver of near-term risk appetite for emerging markets. We saw this play out starkly on Monday, April 8, 2026, when the benchmark BSE sensex fell about 0.5% to 77,166 points, wiping out nearly 1.5 Indian rupees lakh crore in investor wealth. This dip was directly influenced by escalating Middle East tensions and Iran's provocative claims over the vital Strait of Hormuz, which immediately pushed Brent crude prices up over 4% to $79 a barrel. Goldman Sachs, in their June 3, 2026, India Market Outlook, further noted that the sustained Middle East conflict led to rising Indian energy costs, impacting input prices for manufacturers and putting pressure on the nation's trade balance, even causing the Indian rupee to depreciate past 83.50 against the USD. However, the remarkable thing is the market's inherent resilience. Even during these volatile periods, strong Q4 earnings reports from major companies like Tata Consultancy Services, TCS, LTIMindtree, and Avenue Supermarts, DMart, coupled with continued foreign institutional investor, FII, inflows, which topped $3 billion in April alone, provided crucial cushioning. The lesson here is that while global events can undoubtedly create significant headwinds, a strong foundation of domestic growth and robust corporate performance can act as a significant shock absorber. This brings us to a closer look at the key drivers: policy, economy, and market dynamics. Now, let's dig into the engines behind this growth. Policy, economy, and market dynamics. Morgan Stanley, in their June 10, 2024 research, didn't just highlight India's macroeconomic stability, they pointed to it as a key driver for an ambitious projection: 20% annual growth in equities over the next 5 years. They even anticipate India becoming the world's third largest economy by 2027, which is a massive testament to underlying strength. But it's not just internal factors. The U.S. Federal Reserve's monetary policy, for example, casts a long shadow. Purvang Mashru noted on October 14, 2024, how Fed decisions on interest rates significantly influence global capital flows, and India is no exception. When the Fed tightens, money tends to flow back to the U.S., potentially impacting emerging markets. However, the Indian market has shown a remarkable ability to absorb these shocks, reflecting a deep pool of domestic capital. Remember that equity revolution we discussed? Morgan Stanley also points to this increased domestic investment as absolutely critical for sustaining this multi-year bull run. It's less dependent on fickle foreign flows. We even see interesting market phenomena, like the month of the year effect, which Rajesh Ilangovan investigated in Asia-Pac financial markets on January 8, 2022. This research explored seasonal anomalies, hinting at potentially predictable patterns in market behavior, though as we know, predictability is a tricky concept in markets. For instance, December 2023 saw record-breaking rallies for both the NSE Nifty 50 and S&P BSE sensex, an example of this kind of strong close to the year. The lesson here is that a confluence of strong domestic demand, macroeconomic stability, and a degree of insulation from external shocks has underpinned this surge. All of this brings us to the next big question. What's next for Indian equities, and what opportunities and challenges lie ahead? So, what's next for this dynamic Indian market? Morgan Stanley, in their June 10, 2024 research, painted a really ambitious picture. They predict India's economy will leapfrog Japan and Germany to become the world's third largest by 2027. If that projection holds true, it sets the stage for significant opportunities. One key factor here is the continued strength of domestic capital. We're seeing record mutual fund flows, with July 2025 alone bringing in an astounding 427.02 billion Indian rupees, or about $4.91 billion, into Indian equity mutual funds. This deep and expanding local investor base provides a powerful counterbalance to global volatility, capable of sustaining market momentum even when foreign institutional investors pull back. However, it's not all smooth sailing. The ICICI Securities team, in their March 21, 2026 report, explicitly identified external geopolitical shocks as the single biggest driver of near-term risk appetite. Think about the Iran-Israel conflict, for example. Such tensions can cause immediate volatility, as we saw when Brent crude jumped over 4% to $79 a barrel due to Iran's Strait of Hormuz claims, pushing the BSE sensex down about 0.5% to 77,166 on one particular Monday. Higher energy costs directly impact corporate margins and consumer spending. Additionally, keeping an eye on global monetary policy, especially from the U.S. Federal Reserve, is crucial. Any shifts in Fed policy can ripple through emerging markets like India, influencing capital flows and liquidity. The lesson here is that while the long-term outlook remains incredibly promising, fueled by a robust domestic investor base and strong economic fundamentals, short-term challenges are always present. Even with potential downturns, which the stock market crashes in India Wikipedia article defines as double-digit percentage drops, the overall trend points towards sustained growth and resilience. What this means for someone looking at this market is understanding that while the path may have bumps, the underlying forces are pushing towards a significantly larger economy and market. So, what we've seen today is a market that, while clearly subject to the geopolitical tides like the Iran-Israel conflict or a spike in Brent crude over $79 a barrel, is also underpinned by some exceptionally strong fundamentals. The lesson here isn't that India is immune to global risk, no major economy is, but rather that its domestic drivers, from robust retail investor participation to ambitious infrastructure projects, are creating a powerful counter-narrative. When you consider Morgan Stanley's projection of India becoming the world's third largest economy by 2027, with 20% annual equity growth for 5 years, it paints a picture of long-term resilience and significant opportunity, even amidst the current global headwinds. Have you ever invested in an emerging market, only to see it buffeted by a global event? What was your experience like? Drop your story in the comments below. I love hearing your real-world insights. And if you want to understand the math behind how markets like India can deliver those kinds of returns, hit that subscribe button. You'll get detailed breakdowns of real-world financial scenarios delivered straight to your feed. If you found this dive into India's market compelling, you absolutely need to watch my recent video on why Cathie Wood's ARK Invest had a tough 2022. The math behind high-growth investing next. It walks through a very different market dynamic and the critical lessons learned.